Hey, good morning, Atlanta. Welcome to the fifth in a series of Invest Atlanta Facebook Live events for the tech sector, focusing on startups and scale ups in the city as it relates to the COVID-19 pandemic. It's hard to believe that we've all been social distancing for so many weeks, and we're all in this together, and we're going to get through it together. These sessions aim to provide timely and relevant information and inspiration to our tech community and the greater community at large, and are put on in partnership with Invest Atlanta and all of our special partners. My name is Nathan Regan, and I'm the Senior Vice President for Economic Development at Invest Atlanta. Our organization supports company attraction, retention, and expansion, as well as technology sector, creative, and startups efforts in the city. And we're always focused on growing the economy here in Atlanta and helping all Atlantans rise. Invest Atlanta is Atlanta's economic development agency, and we're always investing in our people, communities, and companies in the city. During the COVID-19 pandemic, we've been laser focused on bringing resources and support to the community of innovators and entrepreneurs in our community. To that end, we partnered with the startup ecosystem to bring you this information session today. We'd like to thank our tech partners, Technology Association of Georgia, Advanced Technology Development Center, ATDC, Atlanta Tech Village, ATV, and the Metro Atlanta Chamber of Commerce and the Women's Entrepreneurship Initiative in partnership with Silicon Valley Bank Venture Atlanta, Georgia Live, Atlanta CEO Council, Independent Community Bankers of America, MailChimp, Lab 1866, and the list goes on and on. We cannot do any of this without our partners, and this is what it's going to take for all of us to get through the COVID-19. So we special thanks and shout out to our partners. Now let's get started today. We've got Michael Maziar, who's the VP of Technology Banking of Silicon Valley Bank, Scott Lopano, who's a principal at Tech Square Ventures, to discuss trends for venture investing in startups, COVID-19 and beyond. We appreciate Allison Amon, Executive Director of Venture Atlanta, for moderating the Q&A portion of this session. And we hope that you'll find this information today helpful and that there'll be some sort of inspiration that we are going to get through this together. There's been a lot of concern in our startup community about what COVID-19 is going, what effect it's going to have on our ecosystem. And I think today's session will be informative on how we're going to do this together and the silver linings that we're seeing. So without any further ado, over to you, Michael and Scott, and thank you so much for joining us today.
Good morning, everybody. Nathan, thank you so much for that great introduction. Thank you to all the partners that have helped put this series together. I've found them very informative myself. Feel very fortunate to be a part of this group and be part of the Startup Atlanta ecosystem. Just wanted to introduce myself a little more. As Nathan said, my name is Michael. I've been with Silicon Valley Bank for a few years here in Atlanta. Silicon Valley Bank has been the bank for the innovation economy for over 35 years. We bank both technology companies and their supporters, primarily investors. That's why I'm so thrilled to be joined by Scott here as well, who will introduce himself momentarily. But we basically help move great ideas forward faster. We take a very community bank approach, but have this global reach with offices in 30 locations around the United States and across 7 different countries. We are at the intersection of all sorts of different facets of the innovation economy. So whether you're a hardware company or if you're one of the many popular software companies in Atlanta, maybe you're life science, energy resources, or a part of the venture capital community, SVB is the bank for you. So we bank about 50% of IPO companies that start as technology companies. And we also have a full line of services. Think of us as just a commercial online bank, but really with that global reach. We have been in Atlanta for about 20 years, and I'm thrilled to, again, be a part of this morning's activities. So Scott, would you care to introduce yourself as well?
Yeah, sure. Thanks, Michael. So Scott Lopano here, principal at Tech Square Ventures. We are a seed and early stage venture firm based in Atlanta. And we have 2 funds that we invest out of. The first is more traditional early stage venture focused on seed, post-seed, Series A stages. Typically leading rounds focused on companies that are B2B software, marketplaces, and in some cases, frontier technologies, trying to leverage the strengths of the Southeast and the research universities here. And the second fund is called Engage. You may know it by that name. And it is backed by 11 of the really large corporates here in Atlanta. So Home Depot, Delta, AT&T, Invesco, some names you might know across a variety of different industries that are our financial backers and our strategic partners and serve to help us bring portfolio companies from all over the country, a variety of stages from seed to Series B, in as investments, and then ultimately trying to connect those startups into the corporates and land them as customers or partners, or to help them with their go-to-market strategy. So taking it from first couple of sales, first couple of customers to something that is scaling rapidly and quickly. So those are the two funds. I've been with TechSquare Ventures about three and a half years. Used to live in New York, and no turning back. I love the city and am psyched to be here live and answer questions and talk through some of the trends we're seeing.
Well, thanks for the introduction, Scott. Want to kind of go on what you were just saying. So I think a lot about what we'll be talking about and presenting today really is more for the early stage companies. It's certainly applicable to companies that are maybe just in the R&D stage, or even companies that are really scaling and growing fast. Because what we'd like to present today is, a lot of, what is going on in the past, what has gone on currently, and what that may reflect going on in the future. So I think we're all really familiar with what's going on in sort of what we're seeing in the news cycle with the stock market, but everything that's going on in those sort of larger investment environments is a little different than what's going on in the startup community. So there is, unfortunately, this awful pandemic and a major health crisis, not only in the United States, but across the world. But we do hope to illuminate some silver linings. So yes, there is good and bad, but there can also be some good that comes out of the bad during this time. And you don't really have to just be in telehealth or mental or physical well-being, like we're seeing, Peloton or Headspace, some of the things that are helping keep us sane during this troubling time. But other markets that are on the rise are things that you might not think about. Cybersecurity is really high. Logistic companies are in supply chain. I mean, helping us get toilet paper has been a huge concern. So there are lots of other different categories of companies. So we're looking forward to the question and answer that'll take place in a few minutes here. But before we go there, if you could put up the first slide there for me, please. I'm going to keep my slide presentation pretty limited here, folks, but just wanted to share a few things from the SVB data and insights. So one of the things that SVB is able to do, not only for our clients, but as a public service to entrepreneurs everywhere and investors, is collect the information that we have from all of our clients, from the VCs, and provide this sort of 360 perspective based on what we learned from our clients and what VCs are thinking, and then are able to put out these reports. So we did put out a special report last month, which feels like an eternity ago, and really wanting to look at the impacts of COVID-19 on the global innovation economy, but then also kind of take comfort, because there is so much uncertainty. We don't know when things are gonna turn around for the economy. But by looking at some of the previous recessions we've had over the past 20 years, hopefully that can give people a good sense of where this has potential to head. So the idea is not to scare anyone. I do look forward to answering questions, but we've had this great run in sort of across markets, including in investing in early stage tech startups. Just a reminder, everything we kind of present here will be from that perspective of early stage tech startups. But during this sort of, I want to point out two things here. If you follow this, B column here, this one followed all the way down. So the last recession in 2008, we saw, investments decline almost by half. So this was, kind of a scary time here. But then also, oh, excuse me, that's twice as much as valuations. But if you look at what happened in the first recession, that first big .com era, which I think were more closely represents now, you see valuations didn't really drop that much compared to the investment actual dollars. So while the current market is declining, there are some interesting factors around it, this virus and the oil markets. So there is some, longer term unclarity around what's going to be in the future. Hence, we have these question marks here. Now, the other thing I'd like to point out, just looking back at that time of 2008 and 9 during the last recession, is this, the birth of companies during this time. So even over this 3-year period, you could see the number of, bold founders really stepping out and saying, hey, now is the great time. Now, and I can even say currently what I've even seen over the past 4 to 6 weeks, companies are getting amazing talent. There's lower opportunity costs to go in to the success of your new company. And really, when you can establish, even just a few customers or even just a really sticky product, now you can then ride that next wave of economic growth that comes after a downturn. So that can be a huge first mover advantage for you. And you can see I put up here just a few of those examples, both from 2000 to 2002 and 2008, 2009. So some of the major players in the economy that are even driving the trend in the larger stock markets, such as Tesla, Facebook, SpaceX. I mean, DocuSign. I think everyone's been using DocuSign in this kind of work from home environment that we're all in. But then 2008 and 2009, no shortage of great companies there. Square, Nextdoor. I hope others are using Nextdoor as much as I am to connect with your immediate local communities. But then you've also got Slack and Pinterest, some really strong companies that came out of these kind of darker times. So thanks for putting up those slides. And Scott, did you have anything you wanted to add to the data presented here?
No, I think that's great. I mean, I have a few more data sets and trends that I've been looking at that support all of this, and maybe can provide some additional detail as well. But I figure that'll come up through the Q&A. But I think the points that you're making, overarching, which is that there's a realistic change in deal volumes and deal flows from public markets all the way down to the earlier stage private markets is realistic in past crises, and we can expect the same here. But deals are getting done, and I think there are immense opportunities for companies to be born out of this, even just in the way that the behavior change has been so dramatic over the last month and a half. And I think most would agree that they won't just disappear again. We won't all just resume normal life like a snap of a finger. And so there's opportunities to be nimble and take advantage of those new customer behaviors that larger incumbent companies won't be able to do. So, and I think from the, if I could bring it, the engaged perspective, is that we've been able to get in touch with our larger corporate partners and really understand where they see the roadmaps going. And there's certainly been a variety of responses across different industries, from a Home Depot, who might be feeling it differently than AT&T or Georgia Pacific. But the overarching response has been that there's definitely the sense that this will be a longer recovery and but a sure recovery. So there's confidence in the health component of this crisis, as opposed to a purely economic dislocation like we had in the financial crisis. But that this is also different because it's a supply side shock. So it's not just marketing your way out of the issue, and you couldn't get your hands on toilet paper if you wanted to at one point there. And so I think what's really unique about this crisis, and if I was a startup, would be thinking about how I can play into solving some of these problems is, as you mentioned, Michael, the supply chain issues, the ways to get people back to work to produce product that can then be sold, as opposed to traditional crises where it's been about generating more demand. This is actually renewing the supply. So I think it's unique, which creates opportunities, but that's the high level.
Yeah, I think you're spot on there. I mean, we are certainly, from many of the VCs in town, and then a lot of the VCs I've been talking to across the country, they're definitely staying open for business, trying to fill that deal funnel, and really still doing everything they can to meet startups with great ideas, hearing from those innovative entrepreneurs that just aren't going to sit on the sidelines and try to be, they're trying to change their business to adapt to the market, to really, figure out how can their product or service help people do their jobs better, maintain employees so we're not seeing more layoffs and the rise in unemployment rate. It's really kind of this incredible moment that we're in the surge of creativity and nimbleness, as you mentioned. I think that's a great word to figure out how to provide the most value and those types of relationships that I think companies or even just solo entrepreneurs are able to make now. If you're able to stick by your clients or customers in moments like this, will make them huge advocates for your success post recovery as well. I'm also seeing kind of a difference in customer concentration. So maybe there was a go-to-market strategy that was initially part of the fundamentals of a certain business. We're seeing those expand into different markets, which is also a really exciting and creative way to look at, not just as a victim of a problem, but how can you create more either societal good, customer good, and solve problems that people are facing in this new environment that we're in.
Yeah, great. And I guess now is probably a good time before we open it up for Q&A. There were just a couple small analyses that I've looked at, so maybe I'll share those synopsis here, and then we'll dive into the Q&A. But the first one's actually was done by Revel Partners in collaboration with VentureBeat, so it more so informal poll and survey, but covered, I think, something like 40 VCs in the New York City area, and gave you a decent sense, at least in percentages, of how investors are responding. And the overarching message is that new investments will slow. I think most, whether the pace was 5 to 6, 7, or 8 per year prior to this, it's lowered to maybe 3 to 4 in this coming year. So pace is slowing, but they're not disappearing. I think it's realistic that most, by nature of, one, having to support your current portfolio companies, and two, by nature of investing being a product of understanding risk and trusting and partnering with entrepreneurs, and that there's just some hurdles in today's environment on that much of the investment capital might be focused into companies that are in your portfolio, so supporting them through bridge rounds and new financings, or companies that you've already known over time, that you're starting to see the data points, and maybe now is actually a time of acceleration for them, and the story's changed a little bit. So I do think it's realistic that the ability to build trust with that investor is going to be even more in premium now than it ever was. Lastly, that I think valuations, I'm sure, is on top of everybody's mind. And the numbers here suggest, really only 3% of investors would expect valuations to remain the same. And basically 10 to 40% decrease is consensus across, I think it made up about 80 to 85% of the respondents. So, and happy to dive deeper into that in the Q&A, but a couple of other data points that I pulled to just validate some of the movements that we're seeing historically and today. When investors are thinking about valuations, they're coming at it from a bunch of angles, and one of them is how they would be able to exit. What is the M&A or IPO environment? And the last crises, both in '01 and '08, showed about a 30% decline in deal volume and 60% decline in deal value. So I think the read through there is deals will still get done, exits are happening, but that the premiums on that revenue or on that EBITDA is going to be less. The deal volume, the deal value dropping more than the volume, which when you think about early stage valuations tends to flow through. And that there's about a historically 80% drop in IPO volume. So access to those public markets goes down as well. I think what's unique and encouraging about the really early stage is that you're typically investing with the understanding that exits are coming years from now. And so what's great about those graphs and charts is that even though during the crisis those numbers drop, it always shows a nice recovery. But it's also realistic to assume that what's happening in the public markets, even from a limited partner perspective, when they're looking at our investments, we have to be cognizant of flowing that through on how we're investing in the current market. So I think the conclusion there is that deals are certainly happening. I know we have about 51 portfolio companies now today, so I've gotten to see perspectives across seed rounds that are getting done out to Series B or C, and West Coast, Southeast, New York, Northeast, and deals are getting done across all of those regions and environments. And but I do think those trends are holding true, which is that they're tending to happen where there's higher trust built or existing relationships, and valuations are pretty steady actually. But I think it's realistic to assume that they'll be a little bit lower than where they were, which was sort of above market or above historical norms. Might be returning more to historical norms. I know we're past the 20 minutes, so I'm just trying to, let's see.
Well, I think
last piece
Go ahead.
is seed expansion. We did one analysis, so I'll just make this brief, but on just understanding the amount of capital which was in your graph there, the amount of capital that's come into the VC environment in just the last 8 to 10 years has created so much more downstream Series A and B capital that are investing in larger rounds. And those larger rounds are demanding higher metrics and further traction. And so what we've seen is that the path to Series A has taken longer and has required more capital. And we kind of think about that as seed expansion. So one other thing to think about as entrepreneurs would be, how am I positioning myself best to find the right partner to get me through that gap and reach that Series A hurdle where, generally speaking, I can sort of get out and roadshow and market across the country. And I think that's just all the more important now when go forward plans and forecasts and budgets are a little less certain. So, but that's it. That was last data set to present.
Well, I think those are all great points, Scott, especially the part about really sticking behind your portfolio. I mean, these are the times that you really do want to rely on your investor. I mean, that is, like you were saying, to really choose the right partner. This is exactly one of the biggest benefits of having an investor, to have your back during the hard times, not just financially, but from experience and more of just that strong anchor to guide you through. So really appreciate you sharing your insights, and I think we do have some time for question and answer now.
Great, thanks guys. I think that was terrific. Definitely learned a lot. So for everyone who doesn't know, I'm Allison Eman. I'm the Chief Executive Officer of Venture Atlanta. So I'm the CEO. I kind of said that wrong, but real excited about where we are. We're in our 13th year of being one of the largest venture capital conferences in the country. Obviously, we're navigating through some crazy times, but the biggest thing we know right now is that entrepreneurs need us. So they are definitely going to need Venture Atlanta this fall. They are going to need the opportunities to be in front of investors and to connect with investors. So that being said, just so everyone knows, our call for companies will be out in May, end of May. And you will be hearing a lot more from Venture Atlanta in the next week. So just with what our plans are and how we foresee things in the future. But something to really think about, when Michael was talking about, will you be one of those next companies, the Facebook, the Pinterest, the Square, the Uber? That's what we're looking for. And we know there's some amazing innovation that is going to come out of this pandemic. So I can't wait to see what we have. I know we're going to have some great telehealth companies. I think there's going to be some great ed tech companies, online learnings. The fact that Zoom has become a verb, and that, we're Zooming and what are we doing tonight? Fun fact, my 78 and 76-year-old parents know how to Zoom and taught my dad how to hook up his webcam, and we do weekly Zoom calls. So, everyone can definitely do it. So I'm going to field a couple questions, but love seeing some of my friends on this feed, Dale and Larry and Holly, and it's just wonderful to see some friends. So love this question from Dale Kirkland. So I'm going to pose this one to Scott. Would you invest or lend to a company in this environment without having met the team in person? Obviously, it's really difficult right now. There's not the face-to-face. What are your thoughts?
Yeah, great question. I would say that we would probably say yes, we would do that. At the VC, the Revel analysis from the New York City VCs asked this question really specifically, and most actually said they would too. However, I think what's realistic in the data is most said that they would be willing, but it's certainly not ideal. And I don't think that should necessarily be a barrier, but I do think what it means is there's so much about early stage investing that has to do with reducing and understanding risk and forming and building a bond and trust. I mean, most of the criteria you've probably heard last week as well is investing in teams and products and things that you believe in the future growth of, and it's harder to wrap your head around a detailed financial model and apply some of these things that are shareable over email or online. So it's definitely more of a challenge, but the advice I think coming out of that is just find ways to build that trust in other ways. So leveraging networks and trusted partners like a Silicon Valley bank, like a Venture Atlanta, but you're welcome, guys. No, that's serious advice. It's really true. And even an anecdotal piece of advice is we have other venture firms that will come to us and we're going to others saying, hey, what companies in your portfolio could use capital? You know them, you've known them for a year and a half, you know how they operate, et cetera. So we can get one level removed, right? 7 degrees of separation kind of thing. And so it doesn't have to be other venture investors, but find ways to leverage your network. That's always a challenge, but it's probably more important now than ever. And I would also say, find ways to just increase the transparency. I think it's always hard to let down the guard a little bit when you're pitching and selling, and you're always having to sell. So I get that, but it's really, I think, being genuine right now in this environment, especially with a sort of human health crisis that we're facing, is a unique approach to this, and I think traditional way to build trust with investors.
Yeah. And, everyone's going through the same thing. So it's not like, well, there's a whole group of founders that are able to get in front of people. And I think, what you said about leveraging the relationships, we've always said at Venture Atlanta, I mean, utilizing, the folks like at Silicon Valley Bank or our different partners that sponsor, us, that, it's what it's all about. And, I would think for you, a warm intro from Michael would go a lot further than a cold call from a founder, would get them along a little bit further. So, let me keep going a little bit. So hypothetically right now, do you think it would be better to be a founder or an investor? Interesting, huh?
Very good question. I do think it's a great time to be both. There are benefits and drawbacks to each. I think certainly from the founder, it's a lot harder to get customers. It's a lot harder to maintain your revenue, but just for the same reasons that I kind of described earlier, like starting at, the bottom of an economic contraction, the only place to go is up. Investors, I do think they're sitting on more capital, but they also have their own set of pressures because investors have investors. So they have those limited partners, and it's a harder to do Scott's job now. So I have huge respect for him and everyone out there that is looking to deploy capital. And just to kind of go back to one of those things you were talking about, the last question, I mean, there is something that is, very different but intimate about this environment. I mean, I'm in my home right now. A bunch of strangers online are in my home with me. So that piece about being genuine, I do think there is kind of this, opportunity for all of us to be a little more human, and we are going through this all together.
Right. Absolutely. Absolutely.
Yeah. Only thing I'd add to that, just having seen the different stages, is that now is a good time, I hope, I think, and the discussions I've had with our really early stage portfolio, to be building, to be heads down, to be acquiring talent, to be, you still are getting access to most of the resources you need to build product. It's a harder time to be later stage when you've got just ramped up staff, and now you got to think about how you're going to handle that. You've got team dynamics that you got to figure out, trying to apply for PPP and seeing how you're going to figure all that out. Maybe major customers that you've spent a year or two landing, enterprise customers are churning. And so I think it depends, that founder question, it kind of depends where you are in the stage. But yeah, otherwise I agree with Michael, being an investor, you are sort of stuck in the middle. So sometimes you can be leveraging it to your benefit. Sometimes you find you're getting pulled at both ends.
And I think, the one thing to think about right now is, unfortunately, I mean, I hate to say it, that unemployment's the highest it's ever been. Think about the talent that's sitting on the sidelines. I mean, think about these executives that have amazing experience that could, if nothing else, be a part of your advisory board, that maybe, you're not bringing them on payroll, but you could benefit from their guidance. And, we know that the investors are going to sort of be sitting a little bit. They're going to be evaluating. They're going to be a little slower to make an investment. But, our thought, as we've had our board discussions, is come fall, there's going to be a lot of pent up, need to deploy capital. I mean, the bottom line is, like Scott said, there is an expectation for capital to be deployed. I know NEA had just raised a $2 billion fund. I mean, I know that there's investments going on right now, that Noro just closed something that, Five Elms Capital just invested in a Venture Atlanta alumni. And, what's great is we're still seeing our alumni, our companies from last year, getting funding. So that's exciting. So let me hit this question. What verticals would you avoid in this climate? So is there anything you just really don't want to touch?
Great question. You want to take that one?
Sure, I'll start, but you can hop in. I think, I guess the obvious questions would be, or the obvious areas would be where demand is significantly down, whether it's, an on-site workplace product. We've got one in our portfolio that's seen a significant decrease, just because people aren't in the office. Is it a consumer product are you in the services industries, or are you serving the services industries? So hospitality tech and some of those things are just harder to acquire those customers. Those budgets aren't there. But I think that it's hard to say which ones you wouldn't touch, because it's a matter of the timing and where they are too in the process, because I do think most of those industries believe that bounce back will be strong. So it may just be more of a timing question than a binary yes or no.
Yeah, exactly. I mean, I think there's some kind of obvious ones. We're not the only one that have sort of ranked them. Healthcare is it depends where you are on the healthcare side of things, right? It's being impacted at an extremely high level. It would be very hard to sell into healthcare right now. But if you have, let's say a new technology that's for sterilization or something like that, that's a huge need right now. Certainly, some obvious ones like oil and gas and hospitality, things that are just hit really hard by people not moving. Those are obvious, but like Scott said, those will probably bounce back really hard, because people are going to have pent up desire to travel, to take trips, whenever that time may be. And it might not even be this year, it might be next, or it could be this fall. So we'll continue watching.
Yeah, I think it makes a lot of sense. So I would really like someone to invent scissors that come out of your computer and will cut my hair in the right way. Can someone do that? Because between my whole family, we all are starting to look a little shaggy. So that to me would be a great invention. Or how does someone to cook my family's dinner for me instead of me having to do it every night. So I'm gonna hit another question. So how will the current climate affect availability or access to debt capital? So, just touching on another great topic.
Michael, I'll let you start.
Yeah, as the banker in the room, I guess that one falls on me. You'll see it in a variety of different ways. So yes, interest rates are very, very low, and the point there is to stimulate more, investing in your business. And while it's not great time for banks to be lending, there is an amazing opportunity to do a higher volume of lending. If you are in it also kind of depends what the goals and objectives are, I think, of putting that capital to work. So like Scott was saying, if it's debt to build, I think that's a lot different than debt to procure raw material to make a physical product, just because who knows when we're going to be shopping in stores again. So the other thing is that I think is really interesting that's happening now is sources of capital in debt for like non-traditional lenders. So you're seeing debt funds, not just banks lending. So I do think more fintech companies are getting involved in that lending space. Of course, we have Cabbage here in Atlanta, but the market is certainly changing given the dynamics and the hunger for capital being invested into companies.
Yeah. So, I think we're probably almost out of time, but, just to close on, is now a good time to raise capital? I mean, I know valuations, our company's going to, are valuations tanking, to the point where they should be, sitting on the sidelines, or, isn't a better time when there's less people, it's less competitive maybe for some?
Yeah, great question. I think the valuations point is a good one in terms of, if I were that entrepreneur or founder, I'd be thinking about typically trying to maximize that for the company. And so really at the early stages, especially, I think valuation is correlated to risk, in the sense that so much of the forward path ahead is so unknown. I think you're just going to be sensitive to that. And so really then for me, my thought would be, if I'm the entrepreneur, but also sitting on the other side as the investor, and I'm ingesting some of these opportunities, it's all about the story and why now. I think it's a really great question. Should you be fundraising? And then it's the first one I'm asking, why are they fundraising right now? And is it we're in trouble, or we need extension or expansion, or we need more time? And those are generally harder value propositions to get behind. As Michael was saying, we have RLPs that are expecting us to invest for sort of growth and scalability and those things. And so we're, especially in these environments, hyper scrutinized on investing down the fairway, as I call it. So if my advice to entrepreneurs is, in today's environment, is be thinking about, I think one of the questions somebody asked was, is there a way to approach a VC, or are there certain things that in this new COVID environment that we should be sort of focusing on in how we pitch to a VC? And I think it comes back to the good old fashioned tactics of go look at what they invest in. They're probably not going to deviate too far away from their stated investment thesis necessarily because it's in the midst of coronavirus. If you're a B2B software company, and you're pitching a consumer tech D2C fund, they're probably not going to deviate from that. So stick to the topics and tactics, and really try to hone in on the story. Why is now the right time? And maybe you have a really unique ability to capitalize on the talent that's out there in the marketplace right now, and your incumbents moving slower and being penalized by where they are in the marketplace today, and et cetera, et cetera. And so now is the right time, because there is capital on the sidelines to be put to work. I just think that the story is going to matter more now than ever.
Yeah.
Yeah, and raising money is really, really hard,
Yes.
even in the best economic circumstances. And even for VCs who have to go out and raise money for their fund, it's really hard for them too. So I think, building up that story that Scott was talking about, and not just the personal story of an entrepreneur, but the story of the product, and really showing the resilience of how this can be recession proof, or what makes this such an important issue that people should be begging for this product right now. It's on the presentation, and to have that really compelling story will certainly help the fundraising efforts during this time.
Yeah. Are you guys seeing a lot of entrepreneurs just with major pivots in their product? I had an entrepreneur that I had a scheduled meeting with, and it was to talk about name tags. And I was like, well, what if we, what are you doing for the virtual or online conferences? And she had literally done a complete pivot with her product line, and it was awesome, what she had done. And I feel like there's a lot of entrepreneurs and a lot of people that are just going to be getting more and more creative. My husband's in real estate, and they're doing closings where they're doing a Zoom call and watching people just sign the checks, and then my husband's going with his gloves and mask to pick up the documents and then run them to the attorneys. So I just think there's just some fascinating pivots that are happening. I mean, have you guys heard of any cool stories?
Yeah, we have. One of the cool ones that I think maybe others have seen as well is Gooder, which is a new portfolio company with Engage.
He's doing awesome stuff.
Yeah, they've leveraged their network and expertise on transporting food to really help right now, and I think it's an incredible example of that nimbleness I've been talking about. But I also, tying that back to one last piece of advice, is I think that's a great example of another reason why you're fundraising. If you're fundraising because you've found this new opportunity, you're sort of pivoting the underlying technology to go serve a different need. That's compelling and awesome. I think as an entrepreneur, it's more troublesome as an investor, where most of the time the VC, equity capital is the most expensive. And so you typically want to bring that on when you're going and doing more of the same. I've proven out XYZ and I need capital to go grow that thing, as opposed to I've proven XYZ and I'm taking X and doing whatever, A, B, C with it. And I think that if I'm an entrepreneur, I'd follow the demand and the opportunities, but that doesn't necessarily, that's going to be a harder road to go down if you're raising capital on that. I think it's just try to be innovative, try to find where the customers are. That's the best form of capital anyway.
Yeah. All right. Well, I think this was great. I hope everyone on online enjoyed it. And I'm going to turn it over to Amy Love, who, I just want to thank. She's doing an amazing job keeping our ecosystem going and connecting everybody and getting all of the partners involved. So I'm going to let my dear friend close it.
Thank you, Amy.
Thank you all. This was fantastic. I appreciate the investor perspective. So many great nuggets and good pieces of advice. Interesting trends. I mean, it's not as scary as maybe we thought. So yeah, this is week 5 of these live sessions, and we so appreciate all of you who tune in and comment and submit questions. Please spread the word. Please join our email list. Lexi has posted, her email in the comment section. Thank you so much to Scott, Allison, and Michael. You guys are fantastic, and we appreciate your taking some time out of your Thursday morning to give us a little inspo and help us learn something new and keep us all connected, because that's really important at this time. And so I just want to close by saying we're going to continue to do these weekly, and we would love your input. So you're online, you have a way to reach us, you know how to find us. Please share any thoughts or ideas that you have. And I'd like to thank our partners. This has been a partnership effort, and it's led by a whole ton of people who put together great ideas and try to help us promote these to the startup and scale-up community in Atlanta. Again, Technology Association of Georgia, Metro Atlanta Chamber, Advanced Technology Development Center, Atlanta Tech Village, Silicon Valley Bank, Venture Atlanta, Georgia Alive, Atlanta CEO Council, Independent Community Bankers of America, MailChimp, and Lab 1886. And hopefully the list will grow. This is your tech community, and we want to bring you timely, relevant information during this crisis that will hopefully also drop a little positivity into your day. Thank you, and stay safe.